diversification is good for a reason. And especially, yeah, when you've made enough that you can sustain yourself, then it's more about preserving that than just hitting another grand slam home run or something. So,
Right.
so for me, yeah, I imagine my money would be better off in the markets, but the peace of mind of having a roof over my head that I know is going to be there with whether the markets are down or up is also
Yep.
worthwhile too. So that's why it's like, okay, I'll maybe diversify a little bit more than to.
I want to talk about the kind of the practical reality of living post-fi. And this is something you and I both kind of in different ways because we have different approaches to some of our asset allocations and things. But I want you, if you don't mind, talking a little bit about, you left your job, which you had a salary. A lot of people can resonate with, appreciate that. That's where you pay your bills. So you left your job. What does your portfolio look like? I think you wrote an article recently about that allows you to have the confidence to say, I've got enough money to live this financial independence. Maybe that's just a good, simple place, just a good, simple question to ask.
Yeah, sure. As you mentioned, I did maybe, I don't know, a few months ago, I wrote a post just detailing my whole portfolio. So that it's all stocks. I got about 10 to 12% bonds. I'm actually sitting, so that of the actual portfolio, yeah, it's, 88% stocks and 12% bonds. But outside of that portfolio, I'm probably still sitting on, I don't know, 15 to 20% cash out of the total net worth. And that's because we're thinking of buying a house, which I've talked to you about in the past. And it's actually looking like it's going to be happening, which is going to make me feel a lot better, actually, because obviously March was really scary. And since the 5 portfolio of, the 88-12 split that I talked about could cover our expenses, I didn't want to put this other cash into the market too. And I thought, like, all right, if I put it into a house, then even if things go really bad for a decade, at least we'll have somewhere where we can live.
Yeah.
And that's fine. And it just would make me feel a little bit more diversified. And then now, since the markets have increased so much, then that 5 portfolio is more than we would spend just taking a very conservative withdrawal rate. So for the stock side of things, I'm about 72% US and 28% international. And there's not too much amazing, brilliant thinking going into that. I just looked at a few like efficiency graphs of the various allocations you could have, and that one looked like a good maximization of returns versus volatility.
Right.
And that's it, really. They're all low cost index funds. They're some split between Fidelity and Vanguard, just because my old workplace stuff was at Fidelity, and it's fine. It's low cost, and just I've been too lazy to consolidate it. And I'm in no real need to, because like I said, they're low cost, just as low cost as the Vanguard stuff. But that's it. So that's nothing fancy, and it's just a matter of I was just pumping as much in as I could, and then lots of obviously like tax advantage accounts and things like that, because I was really big into that when I was working. But to answer your question, as far as how we had the confidence to do it, we actually haven't even tapped into it, because my wife's still working. She's in healthcare and she loves it, so she's still working. But then the Mad Fientist, ironically, took off after I left. So we haven't had to tap into it. So that's why I always like to caveat any sort of talk about, how do you feel about these withdrawal strategies with, well, I don't know. Theoretically, I can talk about them, but I haven't had to implement them. And I think that's important, because obviously I feel a lot calmer, especially in times like March, although the income completely dropped for most of this year from that, because all the ways the Mad Fientist brings in income, those companies got freaked out and just stopped doing any sort of affiliate relationships. But again, we don't rely on that money, so it wasn't a big deal. But it still was enough to not feel like I was having to really take out a bunch of money from a down portfolio. So I think it's important to clarify that. But yeah, that the theory is that just taking I think 3.5% would have been my target withdrawal rate, because it's probably as conservative as you need to be based on historical market performance. But yeah, that was always the idea, but haven't actually executed yet.
Yeah, and by the way, I'll link to some of your articles on withdrawal rates, which I do think are great. So if people, and a lot of my listeners are some are all in on real estate. A lot of others are kind of 50-50, or they're kind of dabbling in real estate and they have a lot of stocks. So I think this conversation of asset allocation between different things, like you mentioned, real estate, stocks, and also businesses, which, I think I've always been kind of come from the business standpoint, where real estate is really kind of a quasi business investment. It's got qualities of both, but I've always looked at it as building up income streams, stacking those up. And then real estate has a kind of unique quality of a business that is pretty easy to outsource the management of it. So, whereas a lot of side hustles and things, you're going to have to be involved in it. Real estate, when I was in Ecuador for a year and a half, I was 30 minutes a week, 1 hour per week, kind of managing the manager. So that, I've kind of taken, if you think about the 3 pillars of, well, let's see. Yeah. You got your kind of paper assets, and then you got real estate, and then you have businesses. Real estate has been my main thing. And then I have, over the long term for me, I want to increase allocation to stocks and index funds. And that's kind of, I'm underrepresented there, but I haven't been too worried about it, because as long as I'm finding opportunities and reducing my risk in other places. So I guess my point is just there's different approaches here, but the thing I'm seeing that I'd like your comment on too is, this idea of getting a kind of an accidental side business with a Mad Fientist. And I've just noticed this pattern over and over again, especially people who are younger, who've retired early or left their job, depending just on a withdrawal rate of 3.5%, I personally would not feel, even if the math works out, like I think it makes sense to have these backup plans, like having a little bit of, even a business that makes 20 grand a year, think about how much wealth you'd have to accumulate to do that. So I think you've demonstrated, and I'm kind of trying to do the same thing, that most people who have to depend on their assets the rest of their life don't go all in on any one thing. Like there's always like a diversification impulse, I think. And it seems like that's kind of been whether by accident with Mad Fientist or other ways, you're kind of following that same impulse.
Yeah, definitely. And yeah, like you mentioned, you're wanting to get more stocks. I'm wanting to get more real estate just to balance it out even further. And yeah, just diversification is good for a reason. And especially, when you've made enough that you can sustain yourself, then it's more about preserving that than just hitting another grand slam home run or something. So, So for me, I imagine my money would be better off in the markets, but the peace of mind of having a roof over my head that I know is going to be there, with whether the markets are down or up, is also worthwhile too. So that's why it's like, okay, I'll maybe diversify a little bit more than to.
And it allows you to do there's a trick that you talked about, you're really big on, and I appreciate the behavior, like recognizing that we're all emotional beings, and that as investors, we're going to get in our own way, and we're going to screw stuff up if we just depend on our own kind of judgment. And so I like how you allocate you have a certain allocation percentage. So you mentioned, stocks are 90%, and then bonds are 10%, and then within the stocks, you're 70% or 25% and 75%. Thank you for listening to that interview with the Mad Fientist. I hope you enjoyed it. I would love to hear from you in the comments section below. What did you think about it? Do you have any questions, any suggestions, any follow-up ideas? And if you're not subscribed yet, be sure to hit that subscribe button and the little bell so you don't miss anything. I have new videos that come out every single Friday morning, and I think you'll enjoy some of the ones coming down the line in 2021. And if you like interviews like this, I think you'll enjoy some of my other interviews here on the channel. There's a playlist that you can see in the description of the video below, and also in just a moment in the screen above me. You can click on that to listen to more interviews with people like John Schaub, with Mr. Money Mustache, and others who will help you on your journey to financial independence. Thank you so much for being with me today on Coach Carson TV, which is all about investing in real estate, achieving financial independence, and doing more of what matters. My name's Chad Carson. You can also call me Coach, and I'll see you next time.